You're listening to Insurance Matchmaking, your path to health, life, and Medicare coverage with Matt Libby Insurance. And now, sharing his knowledge, here's your host, Matt Libby.
All right, good morning. Welcome back to Insurance Matchmaking. By myself again today. Don't let that scare you off. A couple things have been coming up lately, and I thought, might not hurt to go ahead and go over some of those things. One of those is short-term medical. I don't know if I mentioned this recently. I think I kind of briefly touched on it, but didn't really go into detail. But one of the things that when we had the ACA marketplace, or when it came about, a lot of people just plain objected to it, didn't want to do it. It's Obamacare. I don't want to deal with it. Some of that, I think, is kind of calmed down. A lot of people, I don't want Obamacare. It's like, well, Obamacare is just the rules for the health insurance. It's not the insurance itself. You're still getting your health insurance from companies like United Healthcare, Blue Cross, Humana, which Humana was in the individual market when we first started. They're not now. Cigna, the big name companies, they do these plans, and they're generally, especially with Blue Cross in our case, it's the same plans that they offer people, same network anyway, not necessarily the same plan, but the same network that they offer employer groups, or if you just go straight to Blue Cross and buy a plan, they're all the same network. So that but they do have plans that are strictly, you can only get them through the marketplace. They've done that for several years. They didn't. Last couple of years, they've put some back in that you can only get those plans through the exchange, but they're a limited network. So there are some, and again, we caution on those. Don't just take the cheapest. That was the biggest thing. The very first year of the healthcare marketplace, and maybe even the first 2 years, Blue Cross had plans that were only offered on the exchange, and they looked like just another plan, and they were. The structure of the plan was exactly the same. So people, well, why would I pay more for this plan when I can get this plan for so much less? And they'd sign up for that plan, and then they went to their doctor, and their doctor wasn't in network, and then they were mad. This insurance doesn't cover anything. And they were stuck in that plan. They either stopped paying, just said, well, I might as well just not have insurance. So a lot of people just canceled those plans, or they had to wait until the next open enrollment for the next year to switch to a plan that was in network. The other thing was, and I'm probably going into more detail, but Blue Cross, since they're kind of the biggest show in town, and I don't think I'm stepping on any toes, had generally two networks. They had the S network, which is their standard network, and then they had their P network, which was their preferred network. So at the time, most of the group plans used the P network because it gave them more flexibility for crossing state lines for care and such things as that. And when they first did that, and coming from the Knoxville area, so I had a little bit more familiarity with it, is some of the hospitals and some of the big health groups didn't take that S network. So it was, if you didn't get the more expensive P network, you weren't covered. So that was an issue. And then, like I said, I think it may have been the third year, Blue Cross said, okay, or it wasn't so much Blue Cross, but these big medical groups said, all right, we're going to take the S network, which really helped explode, I guess, per se, people signing up to the marketplace. Once it was good there, then they were good. The other issue was, there was an issue at one time. They came out at that time, they called it the E-Network. And in our area, some of our listeners may be familiar with E-Network. Nashville and Memphis, and I'm not sure about Chattanooga if they separate, but Nashville and Memphis have the E-Network. Knoxville area has what's called the L network. And again, the L stands for limited, E stands for exchange. So just because somebody takes Blue Cross and you think, well, I've had Blue Cross, I'm going to get this one, it costs less. Sorry, no, they're not in network. E-network in Knoxville is only, UT is the only hospital that accepts it. And generally most of the doctors are going to be in Knoxville itself. So the outlying counties aren't covered, or their local doctors aren't in network. The local hospital is not in network. Now, some of the counties have, like UT has some extension clinics, some neighborhood clinics. It works great there, but again, they would have to go to UT for the hospital for anything routine. Again, if something happens as an emergency, you're always covered. But the way I generally classify the Knoxville network when it comes to health insurance is if the area code for the county is 865, that's the Knoxville coverage area. The counties that touch Knox County have an 865 area code, and basically all of those counties are the Nashville. Boy, I just keep saying Nashville 101. I guess I've moved to Middle Tennessee, and Knoxville I'm kind of forgetting about it. lived near there for years. But if the county touches Knox County, it is part of that Knoxville market. And so the plan, it doesn't matter whether you live in Knoxville or you live in Wartburg. And actually, Morgan County doesn't touch Knox County, but it still falls into that Nashville market for health insurance. So that's kind of an exception. So you do get into the 423 area code, but it's still part of that. The same thing with generally Crossville will be in that Knoxville market too, the Cumberland County, even though you're in 931. But those are kind of some exceptions. But Roane County, Union County, Sevier County, Blount County, those all fall under the Knoxville market. And so they're offered the E-plan, but I don't recommend, and I recommend people, or at least cautiously, approach the E-network plans. They are much less expensive than the S-network when it comes to Blue Cross, but it may not be a network. Ambetter has a network they call their Select. Again, so you got to watch the network. So that's one of the things, again, what makes sense. Talk to a local agent who knows those networks and knows whether that's a good option for you. Just because it's a lower premium does not make it your best scenario. So I kind of got ahead of myself, but the reason I bring that up is don't shop just on price. You've heard me say that many times. The different networks, and then when I was getting to what I was going to talk about, the short-term plans. The short-term medical, because back a little more history, when they did the Affordable Care Act, ACA, also known as Obamacare, one of the things that came up was pre-existing conditions can't disqualify you from getting health insurance. That's partially true. You cannot be prevented from what's called a qualified health plan. A qualified health plan is going to be that ACA plan or the equivalent. As I mentioned, the big carriers also have off-network plans. It also applies to your group plans that you get your group insurance through your employer. They cannot turn you down for pre-existing conditions. Medicare Advantage plans are the same way. Those are all guaranteed issue. They cannot turn you down for any reason health-wise. But they can have enrollment periods. That's why the open enrollment time is so important, or possibly being able to get a special enrollment. Or you do have to act, there is still that, hey, if you're leaving a job and maybe there's going to be 90 days until you're covered at your new job, there are, or you're going to go to a marketplace. You have 60 days from when you lose coverage, basically 62. They give you 2 months to get a new plan, and there's no health questions, and you can sign up. Otherwise, you may have to wait to the next open enrollment period. That's with your traditional qualified health plans. Now, there's always been short-term health plans. A lot of times, and what happened previously, that some people would get these short-term plans, and those were a guarantee of, hey, you still have coverage, that you don't have a lapse in coverage, and you can pick up a plan, another, major plan, because you kept some insurance in place. So part of that, but those don't qualify as what they call qualified health plans. And one of the reasons they're not qualified health plans is they are not guaranteed issue. If you get a short-term plan, that plan can ask you the health questions. They can turn you down for being over a certain weight. They can turn you down because you have diabetes or have had a heart attack or have had cancer. So they're not the best fit for everybody. But what happened, especially prior to just in the last couple of years, when there was a 400%, the cap on how much you could earn and still be eligible for the tax credit, a lot of people didn't qualify for the tax credit, and from the second year forward, the Affordable Care Act plans were no way affordable. The prices on them skyrocketed in the first couple of years. They've stayed rather steady lately. Sometimes they've even come down a little bit, but they're still very expensive. And if you don't get the subsidy, they're not affordable. So a lot of people they're healthy, would turn to a short term. Especially, I have a lot of clients that are like in their early 60s. They just need something for a couple, 2-3 years, and they're going to go on Medicare, and they can spend half as much on their health insurance with that short term plan. And a lot of the company, and the problem is, like, as I mentioned, those plans are underwritten. You have to qualify health-wise for that plan. So several of the companies, pretty much all of them, I think, kind of came up with a 3-year auto renewal program, which worked great, and because it was you locked in, and some of the plans even had where you could lock in a rate and just say, okay, I'm going to pay, and you paid more per month, versus if you just take the rate and then accept whatever the rate increases in the second and third year. But as I mentioned, those plans are all underwritten. You have to qualify medically to get those plans. And what happens is if you just get a 1-year plan, and when it comes time to renew and your health has changed or you've got some upcoming procedures, you may not be able to renew that plan because you now have pre-existing condition. The beauty of those 3-year bundles were you didn't have to go through that health screening in year 2 and 3, so you could renew it and not be in the best health. So that worked out for some people very well, and they were able to keep those plans for 3 years. And that's been a great tool, and I've got a few people that have done those and have renewed for 3 years. The government changed that this year. They want to push everybody onto the ACA plans. So now you can only get a 3-month plan, and you cannot renew it for another 3 months with the same company. So if you need something to fill a longer gap in 3 months, when that 3 months is coming to an end, you have to apply for another plan, but you have to apply for it from another company. Most people are not going to do that. The what we call fixed indemnity plans, those are still available, where you're going to pay for a plan, and it will pay so much per procedure, whether it's a doctor visit, whether it's a surgery, whether it's an x-ray. It'll pay a flat amount. Those plans are still available. The danger with those is they do not have maximum out-of-pocket protection. So that's why I kind of caution against those. Now, the good news is I do have until September 1st to be able to get someone those 3-year plans. So if you're thinking that, well, maybe you might save some money, or if you have a short-term plan and it's going to expire, or even if it's not going to expire but it's only good for another year and a half, it might make sense to see if we can't go ahead and rewrite that now, and so you have it for 3 years. Especially, like I said, if you're in your 60s and you're approaching Medicare, you just need something to get you to Medicare, and then we'll talk about that when you turn 65. So I'm coming up on the break here. I may touch a little bit more on this on the short term here, and then I've got a couple other things I want to add in. So see you after the commercial break.
Hi, this is Marvin Long, your local Twin Lakes Business Solutions consultant. At Twin Lakes, we understand that every business is unique, which is why we offer customized solutions designed specifically for your needs. Enjoy lightning-fast internet speeds up to 10 gig, along with HD TV and reliable phone systems, all backed by our 24/7 customer service. Let Twin Lakes support your business with the connectivity it deserves. Call us today at 1-800-644-8582 or visit twinlakes.net.
Looking to spruce up your home without breaking the bank? Visit Habitat Restore for incredible deals on furniture, appliances, home decor, and more. Plus, when you shop at Habitat Restore, you're not just getting great deals, you're also supporting your local community. Are you looking to make a meaningful impact? Consider donating to Habitat Restore. Your generosity can make a world of difference. Habitat Restore, open Tuesday through Saturday, 10 a.m. to 6 p.m., and located at 560 South Jefferson Avenue in Cookeville.
And now, back to Insurance Matchmaking with Matt Libby Insurance.
All right, welcome back. We're in our second half of the show today. Was talking about some of the changes to short-term medical plans in the first half there. As I mentioned, as long as we write a plan before September 1st, and I think that may be the last date that it can be effective. So like if we we can write it in August for September 1st effective date. You can be good for 3 years. Can't write. The way I understand, I can't write it on September 1st. It has to be written before September 1st to go in effect that date. So, and again, there'll probably be some more information come out on that this summer. In fact, I talked to one of the carriers just this week, and they said they haven't actually addressed how they're going to handle existing clients about rewriting those right now. I think that will work, but one company was didn't like to rewrite plans that weren't coming up and expiring within the next 60 days. So we may not be able to do that with one company, but other companies, it's a pretty simple process. And I have several different companies that offer short-term plans, and also offer, as I mentioned, the fixed benefit or the fixed indemnity plans. So that's something we want to talk about. And I'm going to kind of touch on those again as on the other part that I wanted to cover in this segment for this show. And that is supplemental plans and deductibles. And the reason I bring that up, running a quote yesterday, family of 5. So it really makes a big difference on their cost. And I've mentioned before, cost sharing reductions that happen on the silver plans, on the ACA marketplace plans, which gives you some help lowering your deductibles, lowering the max out of pocket, sometimes lowering copays or eliminating copays on certain things. So if you're at the bottom end of that income level that qualifies to get the tax credit, you can get some really good reductions on your portion, the costs of your health care, not just the monthly premium, but the actual cost for care with that cost sharing reduction. But it's a sliding scale. So as your income goes up, you don't get as much reduction. You're going to be closer to paying the full price for your deductible, that max out of pocket. So the reason I bring that up, this family that I'm working with this week is on the upper end of that cost sharing reduction. Could qualify for the minimum amount, or they're very close to being at the income level where, oh, you know what, you're not going to qualify for the cost sharing reduction. You still get tax credit. You're going to reduce the monthly cost. But the reason I bring that up, a silver plan with it only reduced the deductible a little bit, reduced the max out of pocket a little bit, but it was still about $300 after the tax credit for the monthly premium on that plan. And the reason I bring that up is the bronze plan is pretty much almost the same benefits. Of course, the copays are a little bit higher, and the deductible and max out of pocket are definitely higher. But with the tax credit, this family would be paying $0 for that marketplace plan. Their tax credit would cover the full premium. And as I spoke to this family and said, well, I can put you some supplemental critical illness and accident coverage in there to cover the whole family for less than $300 easily. In fact, was able to do that of the $30,000 critical illness or accident coverage if you have a serious accident lands you in the hospital, plus dental coverage for the whole family. And I think with the dental, it was maybe about, I think it was 2 something, but low 200. So they could get all this other coverage, and it would pay so much for a doctor. It would reimburse some for a doctor visit, or this one didn't cover. No, take that back. This didn't cover for reimbursement for a doctor visit, but if you were in the hospital, it would reimburse that. Or if you got diagnosed with cancer or had to have an emergency surgery for something, it would reimburse for that. So you've got the money to cover the deductible versus the silver plan. Because the silver plan, you go in the hospital, you're still paying the deductible. So even though it would be a lower deductible, you're paying for it. So as I mentioned to people a lot of times, sometimes with that silver plan, all you're doing is buying a lower deductible. And I tell people, you're probably never going to hit that deductible. You don't hit the deductible going to the doctor 2-3 times a year. You don't even maybe hit the deductible being hospitalized once. Now, if you're in poor health, you're going to be hospitalized a lot. Okay, that silver plan might make more sense because you're going to hit the max out of pocket. But then again, bronze plan, you're going to hit the max out of pocket and you're paying a lot less per month. It still might cost you less. I have my story I've told several times of my friend that had to have brain surgery, and he was going to hit the max out of pocket before the anesthesiologist knocked him out at Vanderbilt. And he had to sign a promissory note that he was going to pay I think it was like $5,500 was the max out of pocket. If he'd done the silver plan, basically exact same plan, but it was a silver, so it had a lower deductible, the max out of pocket was actually higher. So he would have been paying $7,700 back, and on top of that have about a $200 a month monthly premium for his health plan, versus I think he was paying $16 for the bronze, if I remember that correctly. So just because it has a lower deductible, that's not the best case for you either. So like I said, sometimes the lower premium makes sense, but also the lower premium makes a lot of sense if you bundle that with some supplemental coverage. And the beauty about the supplemental coverage plans, they don't go up. If you get a cancer plan, it'll lock in that rate forever. Accident plans, same thing. They basically will lock in the rate. The dental plans can raise. Very rare that they do. If they do, it's like, once every 10 years they'll raise the rate 5%, even 10%. But it's not common. But the reason I bring that up is the health plans, the rates go up every year. If you buy the plan, next year, you're a year older than you were today, so the premium's going to be more. If you get that premium, you get that plan now, that premium gets locked in, and you can use it with any plan. So a lot of times I'll tell people, I've had clients that we bundled it that way because they had a high deductible. They were going to have, and then they contact me and go, hey, I need to cancel my Marketplace plan. I got a new job and they're offering me health insurance and it starts the first of next month. And I say, great, congratulations. Are you getting your dental and vision through your employer? If not, you probably want to keep your dental plan. The hospitalization plan, you're still probably going to have a deductible on your health plan. You don't have to cancel those supplemental plans just because you went on a employer plan. So, of course, yes, I want to maintain my commission, but it's also, I want to make sure you're covered. I put that plan in place for a reason because it's going to help you protect your assets, protect your family, and help you keep your house because you don't have medical bankruptcy. So just because you have a group plan doesn't mean that supplemental plan isn't a good fit. And I had a voicemail this morning. Somebody, hey, you helped my husband last year, and would like to try to get that plan reinstated. So I guess probably another job change. So that's what happens. And again, the supplemental plans, just like those short-term medical plans, they are medically underwritten. So if your health changed from when I wrote that plan to today, and sometimes it can be as simple as you've gained 10 pounds and now you across that weight threshold. There's a reason those plans could be turned down. Doesn't matter what happens to your health when you have those plans. Now, some of the plans, depending on how they are structured, some of them reset. I'm going to say, because like a critical illness plan, if it's going to pay so much, if you get diagnosed with cancer and it pays out, you don't pay the premium anymore. You filed a claim on that. That plan's never going to pay again. But some of them, like for surgeries or for accidents, they'll reset. It's like, okay, we paid that this year, but something happens next year. It's a new year. It pays again. So different plans work differently. And again, that's something to sit down with your agent and review. Some plans have resets. Some of them, it's, so many instances a year. Some of them it'll pay something like some of the accident plans will pay so much per accident. So if you fell off a ladder and hit your head, got a concussion, and you go to the emergency room, it'll cover that. And 3 months later, it's icy out, you slip on the ice, break your leg. That's a different accident, and it pays again. Now, usually what they'll do, they'll pay for like so much for the emergency room. They'll pay so much for the doctor visit. But like if you were hospitalized for both times and it has a hospitalization benefit, that's usually only once a year. So as long as and usually those plans, most plans like that will be the anniversary of your plan. So you're going to have an annual reset on a lot of plans. If they have a reset for deductibles or resetting the benefits, it's going to be annual usually, and it's either going to be the anniversary of when you put the plan in effect, or it's going to be January 1st. It's going to be one of those two. So it's pretty simple to figure out when your resets are. So if you bought a plan, you only had it like about 4 months, and you bought it, at the end of the year, I would not assume it resets on January 1st. Assume it's going to be, August 1st or September 1st, whenever it was, that you got the plan. So that's something, and again, review with us or review with your agent if I'm not your agent. If you have a plan like that, and you think, well, maybe it's not all the benefits I have, get with us. We can do a review on it. I'll be the first to tell you, I can't beat that. Hey, you bought that plan 5 years ago. You're 5 years older now. The plan that I would replace it with, you're paying for it at your current age. You're further ahead. So I use the old Boy Scout motto or policy of, leave it better than you found it. That's what I do with my clients. If I can't put you in a better situation than you are now, I will leave you where you are and leave you on the plan that you're on. That's what's going to work best for you. So that was, like I said, I wanted to kind of talk about those supplemental plans that, fill those gaps. We talk about Medigap. But there's always gaps in insurance. In fact, there's plans, in car insurance, you get gap plans that will pay off your car, even though your payoff is more than the car's valued if you total it. There's health plans that do kind of the same thing, that And there's some plans out there haven't done that kind of plan in quite a while, but there were plans that were designed to, okay, your deductible on your plan's $3,000. That's what this plan's going to pay if you end up with a serious, you go to the hospital or you have a serious accident or something. It's going to pay that $3,000. And those plans usually would have a reset that they were good again for the next year. You just couldn't use them, in the same year. So again, it makes a difference if you get the plan when you're younger. Same with life insurance. You've probably heard on here when I talk to young people, get your life insurance now while you're young and healthy. Don't wait till you're old and round like me, because it's going to cost a lot more. And smokers, if you smoker in some, it depends on the company. All of them. I mean, if you smoke cigarettes, they're gonna hit you hard with the premium. But some companies, it's any tobacco use. Some companies, if you do nicotine gum, nicotine patches, you do vaping, that's all nicotine. They classify you the same as a smoker. So it depends on the company, and that's one of the things we can look at and we can shop around. And maybe you vape, maybe you smoke so we used to say the wacky tobacco. Some companies, you have, if you're being honest and answer the questions truthfully, if I see you lighting up a cigarette, I can't fill out a plan and say you're a non-smoker. And then again, depending on the level of life insurance you may be applying for, you may have to do a paramed and they will check for nicotine. So it doesn't matter whether you light or not, they're still going to turn you down or raise your rate because you're a tobacco user. So I've rambled on. We're coming up on the end of my time. And so until next week, see you on the radio. Don't forget to go to insurancematchmaking.com to offer suggestions for the show or find out how to contact us to see how we can help you. So look forward to talking to you again next week.
You've been listening to Insurance Matchmaking with Matt Libby, your path to health, life, and Medicare coverage with Matt Libby Insurance.